Hello, traders, and welcome to our Traders Talk show. Today, we got an amazing guest speaker today for you all. Just to give you a just overview of Traders Talk, the purpose of Traders Talk is to give you the truth of trading by interviewing top traders who trade for real and give you different perspectives to trade the markets on the smart money framework, including also performance coaches who help us achieve our outstanding consistent performance in the market. Now, today's speaker is Stephen Goldstein. Stephen Goldstein is one of the leading performance coaches in the financial markets. He's also the best-selling author of the book, Mastering the Mental Game of Trading. His specialty is in helping people achieve transformations that lead to greater effectiveness and stronger risk processes. Stephen's unique coaching approach is born from his extensive experience as a trader, combined with powerful coaching techniques and a distinctive model developed from his psychotherapy studies. This allows people to understand their risk processes more clearly. Over the past 10 years, Stephen has coached some of the world's leading traders. His clients span the globe and work across various markets ranging from billion-dollar hedge fund traders to private retail traders. He also hosts the hugely popular Alpha Mind podcast. Before becoming a coach, Stephen worked as an investment bank trader in the rates and FX space for almost 25 years, starting in the mid-1980s. Stephen, welcome to the show. It's such a pleasure to have you.
It's an absolute pleasure to be with you.
Stephen, just before we get into it, I must say just a quick overview for all the listeners listening in is I really enjoyed your book. It was phenomenal, Mastering the Mental Game of Trading. And I must say, phenomenal job on that. Amazing stuff, right? So there's a lot of stuff that I want to really share with the traders. I'm really passionate about the book, and I really want people at the end of this, to really get into the depth of the book as well, when they get a copy. But before all of that, just a little bit of background about you. So tell me, 25 years as an institutional trader and then now performance coach. So how did it all start? I mean, what event triggered it?
Well, it was really it was the mid-1980s. I was just a young guy, early 20s, and the markets as we know them now were really only starting to open up in the early to mid-80s. We had a period of financial liberation starting in that period. Futures exchanges were opening up. Currency exchange restrictions on moving money around the world were removed. Derivative products were starting to be invented because you had the ability to hedge, and you had a lot of liquidity in the market. So there was this big demand in the UK for traders, for young traders, in trading firms. And I was in London, so I suppose I was in the right place at the right time. I didn't know a lot about it. But it sounded interesting. So it was it just attracted me, and that was it. I was in it and I loved it, and it took off. I didn't know what I was doing really. I got employed by a Japanese bank, learnt the trade, learnt my way into it. Didn't really know what I was doing, but we got mentored by colleagues who probably didn't really know what they were doing. And that was it. But it was fantastic. It was. I got a buzz for it very quickly, and that's where it went from there. So it was a start of a long career. I went on to Credit Suisse, that's where I became the sort of trader that I really started to become more successful. I moved on to Commerzbank, the German bank, in the late 90s, and then I eventually ended up at American Express Bank in the 2000s, and nearly 25 years of being a trader, and I loved it.
So then, what then happened, Stephen? Like from that to a performance coach, what then triggered that next phase of your life?
Yeah, well, I had a coach, which was quite rare for traders to have a coach, but I was put into a trial trader performance coaching program at Commerzbank. I was the only one in it. It was a one person trial, And I, I, it changed my career. It changed my direction as a trader. It changed my whole way I managed and engaged with risk and markets, and I became a much better trader after that. And 10 years later, I went back to that coach. Really, I was seeking some career advice. I was thinking of joining a hedge fund, and I was looking at a new direction. And he just said, "Look, Steve, I think you'd be a good coach if that's the direction you want to go in. Have you ever thought about that?" And that just, I fell in love with that idea. I'd never considered it ever, and decided that that's what I'd like to do. And went through this whole different departure, and that's what I've been doing for the last 15 years.
Amazing, isn't it? How I always am amazed at how the sequence of events in our life they happen and to shape us from one phase to another, and it's beautiful transition as well, right? You would say in your life, how it, as a trader, you're in the right place at the right time. You love the buzz of it, then you went on to becoming a performance coach, and now
Yeah,
you've been in it for 15 years.
yeah,
Amazing orchestration of life. Whoever is orchestrating it, the invisible hand of grace.
that's right. The invisible hand,
Yes.
very much so.
Now, coming into a little bit on the overview, so that we just get the ground a bit right, so that the viewers can understand these terminologies as we use them as we go further. I love the fact that you referred to trading as a performance game, very similar
Yeah.
to sports. I can't agree less. So for the viewers to understand a little bit more, what would you say actually the difference between psychology versus performance would be?
Psychology is more of an academic subject. Um, you know, performance is about actually how you do something, and there is so much more to it than just psychology. Psychology is just a component of it, and it's a broad aspect of all performance activities. Mindset, um, uh, mental state, ability to stay calm and not become over emotional, or ability to tap into our emotions when we're doing something and to get the best out of ourselves. They're all psychological concepts, but they're just factors within performance. Performance work, covers so much more. It's about how you actually do it. It's about engaging with risk, engaging with, turning up. It's physical and mental. It's mind, body, and soul. It's the whole thing, and it also requires knowledge and skills and technique. So performance is so much more than psychology, and psychology is just a component of it.
Very nice explain. I think that's important for people to understand as we go further, which is psychology is just a part of the performance metrics. Now, in terms of that, if I were to ask, you've worked with both kind of traders, institutional as well as retail traders. So what would you say would be the different performance challenges that both of this category of traders are facing?
Yeah, well, again, there's a very different path into it. If you start off working in an organization, normally you start off working for a trading company like an investment bank, or an energy firm or a commodity trading firm. And these are firms that are at the epicenter of the market. They make markets. They often are producers, or marketers of particular, of energy, oil, foodstuffs, and they have these trading teams that sit there, that really manage the exposure to the market of the products they produce, and hedge, and are involved in quoting prices to clients who want to buy and arranging, making sure that the company is not exposed to a large order from a client, or to make sure that they can fulfill that order. So they sit at the epicenter of the market, which of course, as you know, is very complex, and it involves huge risks. So that when you're working in a trading firm, it's a very different existence. You're part of that process. You're part of the system. You work inside the system of the markets. Okay. When you're a private trader, when you're a retail trader, you're working completely outside the system. It's a very different existence. It's obviously you're trading with the market, but often it's a very different job. The things you have to do, the way you engage with risk, the way you engage with markets. Okay, if you want to buy or sell something, you go to a market maker usually, or through your broker, you'll go to a market maker. And that market maker doesn't necessarily choose to take the position, but he then has exposure to it after, someone's hit his buy or his sell order in the market, and he has to manage that. So he doesn't choose always when he goes in or what exposure he has. He has to manage them, and the trader will have multiple exposures, which he's forced to manage, and seeks to do so in an optimal way. Whereas a private retail trader, you sit outside the system, you decide how you're going to engage with the system, and you have far less information. You have a far more challenging job in many respects, because you don't have any edge on your side. If you're the trader inside the market, you're being hit on your bid and offer, and you're seeing the liquidity. You've got so many orders, so many trades coming into you at any one time, that gives you an incredible feel for what's happening, for where risk is, where danger is, where opportunity is. And you're working in and around many other traders in large teams in trading rooms that can be 200 people that are all trading in the market at any one time, and there's a huge flow of information going on. And that kind of talks to you almost, being in that situation, as opposed to someone at home with none of that, who has to find a way to engage with the market where the edge is against them. And you really have to adopt or find some sort of system or method that enables you to do that. And as we say, the edge is completely against you, and the edge completely with the market maker. So that's a very big difference.
Very nice. And I think that resonates with what most people usually say, and that retail trading is, compared to when you're part of the system and the institution, is far more challenging and tougher. Would you say that?
Well, it is. There's elements of it that can be beneficial as well. So, for example, you don't have to have risk on. So just imagine that I was a market maker at a large investment firm, investment bank, making foreign exchange, say euro dollar prices, and running the euro dollar book. And someone comes along and asks for a price. They want to buy or sell. We don't know. They just ask for a price in, say, $100 million. Okay, it could be a speculative position. It could be to cover some financial purchase they're making in their business, a property investment. We don't know, and we'll never know. But they need to transact that in the market. We make a very tight price as a trader, and then the customer says, "Yeah, mine or yours." They lift you or they give you. They do it obviously electronically these days mostly. And suddenly you're running that position, as you know, within milliseconds. It could be against you, and you could be a long way offside and losing money, and you didn't want to have that risk. So on the other hand, as the retail trader, you choose when you want to have risk on or not, when you want to transact with the market. Obviously, you'll be guided by a system, but it's your choice, and you don't have to have risk on some days or some weeks, and you may want to put it on other times. You may want to put it on multiple times during the day. It's up to you, but you still have ownership of when you engage with the market, in theory.
I guess there's always pros and cons in both worlds, and
Yes.
yes, exactly right. It's good that you explained that so that people understand both the worlds of trading. Just in relation to that, I mean, there are two kinds of approaches you talk about in the book. Now, before I give that away, I just had a small slide prepared on that for the viewers to look at, and then if you guys can see that, let me just share my screen in a minute. I'm going to show you two questions, or two statements, shall I say, and the viewers, or even on YouTube and me, you can just type into the chat box which one you resonate with. Which of the statements do you resonate with? And this is in the book, Mastering the Mental Game of Trading, and it goes into so much more depth into this as well. So which one do you resonate with? You never go broke taking a profit, or you never go broke taking a loss? See, if you want to just type that into the chat box, I think that would be good. And just give you all about 1 or 2 seconds for that before I talk to Stephen about that. Okay. Okay, good. So if you just want to type in just 1 or 2, I think that'd be good. As you guys are thinking about that, I will carry on with the questions. So the first one, Stephen, where you
Yeah.
talk about you never go broke taking a profit, you would classify that as the house approach, and the second one as the player approach. Now, would you say that all the traders you've worked with fit into either one of these two categories? And have you, yeah, I think let me ask you that first. Would you say most
Yeah.
of them fit into
Yeah.
these two
Yeah.
categories?
Everyone fits into one or the other. Some people try to say both, but I find out that actually there's qualifications to that, and they're predominantly one or they're predominantly the other. So
Okay.
if you never go broke taking a profit, okay, that mindset is the mindset of what I would call a house trader, someone who's working as if they're working in a sales side firm in a market making role. Um, not necessarily not that they are, but they're trading as if they were in that philosophy. And the other one is you never go broke taking a loss, is what I call a player approach trader. And they're usually working on the outside of the market. And they're taking a very different philosophy to how they engage with risk.
The only thing, when I was looking at this, I think I got confused because I was thinking, okay, but loss is usually, and that's what you explain in the book later on, you're talking about a calculated loss, right? Before coming into the trade. And that's what you would classify as the player approach, or is it even those guys who don't even take a calculated loss
No,
for a predefined
I would classify that as the player approach.
as the player approach? Yes, that's
Yeah,
right.
although there are variations on that, they would not necessarily qualify the loss. So obviously, there's many different nuances within them, but generally, that's the generalization.
So that the viewers get a bit clear and going forward, because we're using this terminology, so you would say like swing traders would come under the player approach, which is the second one, and the house approach would be the scalpers and all of that, which would be the first one. Is that right to say?
Yes, yes.
Okay. And have you seen one group outperform the other, or is it
No,
just a
no,
matter
no.
of personality?
It's all up to your personality. There's benefits to where you do it. Um, if you're working in a market making firm or a sales side firm, and you're involved in that sort of trading, you pretty much want to be doing the house approach because you're working in a house company. You've got the edge there, and you're required to be the house. So it makes sense to do it that way, but you can do it without being in a sales side firm. It's the way you engage with markets and risk that matters. And I normally say that if you're outside the system, you're better off using the player approach.
Okay.
Again, there are people outside the system that use the house approach and make it work. And there's players inside the system that use the player approach. They're outliers, they're exceptions, but generally that's it. Because if you're outside the system, you need that protection. Whereas if you're inside the system, there's usually you're in a company that usually has a risk management process,
Right.
and that they provide that for you, and you have a much larger balance sheet as well, and that gives you extra resources to use.
Brilliant. Okay, that makes it very, very clear. Now, coming on to that, I mean, this is the main core of the book, and I really loved the model that you had designed, which was the performance cycle process, and it comes up with these 4 quadrants. Now, before we go into a little bit of an overview on it, just a quick question. I mean, I was quite curious. How did you come up with this model? Was it something that existed and you modified it, or was it totally from scratch by working with many of these institutional and retail traders?
I actually came from diploma course I was doing in a form of psychotherapy. So when I was learning coaching in the early years, I found one particular form of coaching that was really interesting for me. And it was closely connected to a form of psychotherapy. That and when I was at this one of the workshops for this particular diploma which I was studying, they introduced a model which looks a little bit like that. And they were describing how it helps people meet their needs when they're engaging in their everyday activities. And as they walked us through it, I realized, this is what we do when we're trading. We're engaging with the outside world and with ourselves. We have a need that needs to be met. And it follows a particular path, a kind of a path about that changes as we engage with uncertainty, with the external environment, in this case, the markets. And it affects us. And we need to manage that and try and stay optimal, so as not to have an unhealthy connection to the outside world, the markets, in other words. So I was learning about this model, which is called the cycle of experience. I found myself thinking, wow, this is trading. This is what I do. I'm seeing exactly the challenge of trading in this model. And then I started, as I was coaching people, it started to form in this form. I found myself starting to explain the model, but in a way they could understand and it could resonate with them, because it doesn't look as clear and simple and the language as this. So I sort of started redefining it in a way which might work for people who don't really understand some of the therapeutic terms and terminology that goes with it. And I wanted to make it simple and structured in a way as well, such that I could actually engage with people on it without them knowing that it's this psychotherapeutic model, because I would probably lose them at that point. And I use this when I'm working with people, and I go through and unpick their trading and deconstruct their trading and try and help them understand themselves, the different parts of the challenge of trading. And it can have enormous power in enabling me to help them become better traders.
Amazing, yeah. I was quite curious to see the origins. Okay, that's where it came from.
It's not just trading. We use it in other things. I coach leaders, managers, teams, entrepreneurs, partners in large firms. It's not just trading that I work with. And I use this model and framework in those companies. In fact, we're just in the middle of arranging and putting together a series of workshops for a major European investment bank that's going to go out to thousands of, going to be presented to thousands of their employees in both in-person webinars and live webinars. And I've used it. We've also showcased it across the world for one giant commodity trading firm to their traders in one particular part of the firm, to try and help them understand what's happening for them as they do the job, so they can do the job more effectively.
It's such a phenomenal model that can be cross-transferred. And one thing that I did always come across was most of the principles that you talk about in the book and using this model is principles of life as well. It can be applied so much in different areas as well.
All areas. This is really a task completion model, or a task completion cycle. For any one task, whether you look at it as a simple task that takes seconds, or something that could be years in the making and construction and management of. So it's a human needs cycle in a way, becoming aware of how we are as we do something, helping us manage it as we engage with that external world, and then helping us deal with the aftermath of it so that we can remain this, in a healthy, constructive way for how we navigate the journeys that we go on.
Beautiful. Now, then nicely swifting into the model, I know we don't have that much time. If you can just give us an overview, especially where just so that some retail traders can resonate with, in this quadrant, where would the entry or the trader clicking the button to enter into a trade happen? where the trade management will happen, and then where the exit, and then where he would be just flat and resting. So if you give us an overview in that sense, that'll be really helpful.
Okay, so it it'd be lovely if it was as black and white as it looked. Okay, so the model is always a very simplistic version of reality. All models are. But if I was to, I like to describe a situation. Imagine you're a trader. Let's just say you're a discretionary trader, and you're trading, the Indian stock market or the Indian market index.
It's mainly in London, actually,
Well, they're
Stephen.
in London. Okay, so they
Oh,
could be trading the
and
UK
US, mainly
markets.
US and London,
Okay,
yes.
so you're going to have a lot of S&P traders on there, a lot
Yeah,
of guys
yeah, yeah,
trading
yeah.
S&P futures or NASDAQ futures. Um, so imagine that you decide, I'm going to take a year off. Okay, I've I've had enough of the markets for a year. I'm going away. I'm going to travel the world. I'm going to hire a yacht, go around the world in a yacht. I'm going to completely disconnect from markets. I'm not going to look at newspapers, the news. I'm not going to listen to anything. I'm not going to engage with anyone for a year. And then after a year, I'll come back into the market on the 1st of January the following year. So, so imagine that you walk in on Jan 1 or Jan 2 or whatever, and you sit down at the screens. You're not going to start trading at that point, are you? You need to start understanding what's going on. You need to understand the environment. Okay, you need to understand what's been happening. So you need to get your sense of being, okay, before you even start. You need to have a sense of what is happening and how you're being in that place. You're probably going to come in with no biases, no feelings about the market, not aware of anything that's happened. So you're not going to have a belief that, we're in this major bull run, within this major bear run. You're just going to look at the price today, and then you're going to start asking questions. You're going to start sensing. You're going to immerse yourself in the market in that first few days or couple of weeks. Okay, just to get, because you don't know anything about it at that point. Okay, so you want to start sensing it. That means you ask questions. You use your senses. You use your eyes, your ears, your mouth, your nose, your mind. Okay, you develop a feeling for it. You start trying to look back at what's happened over the past few months. What's the big news stories? What's the big drivers of the market? You start asking people, and you want to hear what they say. You want to listen, but without judgment. Okay, so you as you're asking all these questions, you're building up a picture of the market. Okay, you're gaining a sense of it. Okay, you're not doing anything yet. You haven't got a view yet. Okay, you're being non-judgmental at this point. Okay, and as you do that, triggers start to happen, views start to form. Okay, it could be a research report you read, maybe some data, some news, an opinion. Maybe it's within you, maybe you reflect on something and think, this is cheap here, or you may have a system that you want to bring into play that acts as the trigger for you. Okay, that's that gives you a kind of non-discretionary input. You might be using the charts. You might see a moving average crossover. You might see a large down day, or a particular chart pattern. Okay, you might see the breakout of a line. So you've got all these potential triggers that make you think, okay, something's happening here. I need to know a bit more about it. So this is where you now move into the production phase. Okay, this is where at that point you are not in the trade. It's just about you and your being. Okay, and how you're engaging with the world. But you're not doing anything yet. You're not committed to anything yet. Okay. Once you get into the production phase, phase 2, that's something has triggered you to get in there. And you now start becoming more subjective about things. You start trying to make sense of everything that you've been watching and reading and forming a view and opinion. You start to become aware. And as you start to become aware, you start mobilizing to act. You might have a view. You might think that's cheap or that's expensive, or, the market's going to come in and contract or expand or break out. Doesn't really matter. There's lots of different ways you could cut it up, but you start forming an opinion. Okay. And you start deciding, am I going to do something? And you have a playbook. You will have a playbook. It might not be formalized. It might be in your head. You might have a formal playbook. It might be systemized. Okay. Which takes a lot of the heavy work out.
Mm-hmm.
Okay, because that more or less tells you what you should do.
Mm-hmm.
Okay, but you've got to start thinking about, is this worth doing the trade? Just because I think it's going higher, what is the risk reward to that trade?
Mm.
Okay, what's the liquidity like? How much size should I put on? How much capital have I got that I can commit? What percentage of my capital? Where am I going to leave any stops if I have them, or contingencies to get out if I'm wrong?
Mm.
There's all these things that this is where you prepare to act.
Mm.
And then you get to a decision, am I going to act or not? Yes or no?
Mm.
Okay. And if you decide yes, and you've decided how much, when, what price, then you should act. But just before you act, we have a problem. And that's because we're human and our emotions start to come into it. And we start to worry and we start to be concerned and we start to think, what if it goes wrong?
Mm.
What if I don't get the desired outcome?
Mm-hmm.
Okay. What if I look stupid? Okay. What if I suffer the equivalent of stage fright? Like I said, it's a performance activity.
Mm.
You ask those questions. What if? What if? What if I don't do it and I miss out? Fear of missing out. What if I do it and it goes wrong? What if I do it and it's not enough? What if I do it and it's too much? Okay. This is where the self-doubts come in.
Mm.
The human element comes in. The emotional element comes in. Okay. What if I look stupid? What if I fail? What does that mean for me? Who am I if I fail? Okay. What if I keep failing and eventually I lose all my money? And I'm a figure of ridicule and everyone's laughing at me. We go through these in our mind. We catastrophize. Okay. This is just before we actually act. We haven't even placed the trade yet, but we've got all this noise going on.
Wow.
Okay. When really we should just be doing the trade because the production phase says, do the damn trade. Your playbook says, do the trade. I meet people that build systems that are supposed to make the trading decision easy for them. And even then they still go, okay, so I backtest this system and it's got this great breakout pattern and it says I should buy, but what if it's wrong this time? They still do it. They still question the very system they bought that's supposed to make decision making easier. Okay, so as we get to the performance phase, the emotions are building within us. Okay, once we're in the performance phase, we've acted. Then our emotions are elevated. This is the performance phase. This is enter stage left. As I say, it's a performance activity. Okay, this is like, you're coming out to bat for India for your debut and the whole world is watching you. Okay, and you don't want to mess up. You're thinking about messing up now and your shot's going to be awkward or, you're going to go out for a duck. And, all this performance anxiety comes into play. You feel like all eyes are on you. Even though they're not, you feel like it. Okay. You feel the whole world is watching you. Your emotions become highly charged. And this is why we mess up. We should just be following what we were decided we should do in the production phase. But we're watching the market go up. We're watching it go down. We're suddenly out the money. We're in the money. We look at our P&L, it's negative, or we look at our P&L, it's positive and it makes us feel good. And I'm going to take the profit. But now you're not following the process, the plan. The plan said stay with the trade. Don't take the profit at that level. The plan was on a 5-to-1 risk reward, and you've just ripped it at 1-to-1 risk reward because you don't want to give that money back. And you've messed up now. Or you move the stop, the money goes against you. You go, okay, this is going to hit my stop. I better take the stop off because I don't want to be stopped out because it's only a temporary level and it'll bounce back up and I missed the big move. So you mess with the stop. The stop is there for a reason. There to keep you alive. It was part of your plan, your playbook, your process. You've just messed it up through so staying on the trade. See that part of the circle between the act and outcome. You need to stay on that. Okay. But trying to stay on that is difficult because all the time, from the moment you act, even before you act, you're already thinking about the outcome. You're supposed to let that outcome happen as a result of what you do in the production phase. But all you can do is think about it. And you get caught in this backward and forward between acting and outcome. Should I, shouldn't I? Should I take the product? We get so caught up in that. That's where the spiraling comes on. Okay. and we get caught in these vicious cycles. The devil takes over, and we're off the trade now. The angel says stay on the cycle. The devil's on the other shoulder going, no, 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 take the profit. Go on, you look great. Everyone's going to love you. Okay. Kids, now move the stop, move the stop. You don't want to get stopped out here. You know it's going to bounce back. Take the stop off. Okay. You know, it messes you up. That little bit comes in. That's your ego, your mind. It's messing with you. It's really difficult to stay on it. Everyone is wired the same. So whether we think, you know, no one else does this, actually you're all doing this. Okay, you're human. And that's the really difficult part of all performance, is that we're human. It enables us to be great. It enables us to do extraordinary things, but it also undermines us when it's misfunctioning and misfiring and going into our spirals and vicious cycles. And we all do it in some way. Sometimes we do it, you know, this is where we can develop bad habits that become kind of incubated into everything we do. Okay. And then before we know it, we can't change those habits because they're so ingrained in us. There is only one way out the spiral. Okay. You have to go through the final phase, the letting go phase, the fourth phase. I can tell you that is where the game is won, because so few people engage in a good way with that. So people go through that. So few people think about it. When I meet the very, very best traders, incredible private traders, retail traders, hedge fund traders, investment bank traders, commodity traders, they do this part better than anyone else. That is the foundation of great performance. The ability to deal with the outcome, accept it. It's not easy, because you can have a million should haves. If you had the what ifs just before the act, you have a million should haves just after the outcome. Should have done this, shouldn't have done this, should have listened to that person, shouldn't have listened to them, should have done more, should have done less. You know, we can go on and, you know, we can go on and build a whole list of those. They are going to come in because you're human. You're going to question yourself. You're going to doubt yourself. You're going to challenge yourself. You're going to be annoyed with yourself. Okay. That is what's happening just after the outcome. Somehow it's that gets you going, rushing back in to go again, rather than stay on cycle. You know, I knew it was going high. I should have stayed longer. I'm going to buy it again now. But now you're doing it without going around the cycle. You're just doing it as a reaction because you feel like you've missed out, or you feel like you've been an idiot. You should have stayed with the trade. So you just buy it without any anchor points, without any plan now. And then it goes wrong, and then you suddenly cut out. Oh, I knew I shouldn't have bought it. And you sell it, and you've lost money, and you get caught back and forward non-stop. The skill, the ability to let go and crucially reset. It sounds easy. It sounds like a throwaway line. So few people can do it. You know, that is the secret. That is where mastery comes from. Okay, I rate people generally as a metaphor here. Generally, in terms of the ability to let go and the ability to even engage with it, as about 2 out of 10 for most people. When I meet great traders, they're often no better than about 5 out of 10. But that is a lot better than 2 out of 10. That is enough to make them really good. And then every now and then I just meet some extraordinary people who I rate 7 out of 10 when they're on it. And when they're on it, they can do incredible stuff. And that's what you see great athletes do as well. Great tennis players, you see do that. Great boxers, great sports people, great musicians, great cricketers, great footballers. The ability to deal with something, process it, move on, and come back and be brilliant again and not be owned by what happened.
Beautiful.
And you see the same with great traders. It's all in there.
Amazing, Stephen. Thank you for giving that. That's one of the best, wonderful insights. And I really wish that the clients are really getting this, how invaluable this diagram is over here. And in the book, Stephen goes into this into much more detail. I know time is flying by. It's amazing talking about this. There's only about like 10 minutes left. So I'm just going to do as much as I can to ask all the the rest of the questions. Just a quick one, Stephen, on this quadrant. If you want to just give us a very quick answer, which quadrant here would you say that most of the traders are facing challenge in?
Well, it's the whole thing. It's, it looks like we're doing it as a separate thing.
Mm-hmm.
We're engaging in all of it. The part that people don't engage in the most is the letting go and the reset. They're not good at it. Okay. And even every trader, even the best, they have every now and then they'll fail at this. They'll get caught up in a spiral or a cycle. Okay. So it's that there's, if you don't come at it, if you don't engage and reset, you can't get back to being healthy in the being phase, which means you're going into it all wrong. You're not going in with an open mind. You're not going in, you're not debiasing. You've got to have a clear head as you go into that being phase. Everyone messes up. It's funny that story I said about taking a year off. I was listening to the brilliant Stanley Druckenmiller podcast last year with the head of the Norges Bank. And he told a story from, I think it was back in the year 2000 when or 2001 when there was a stock market crash, and how he bought stocks at the very top of the market, tech stocks, having previously, decided he didn't want to be long of this rally because he didn't like it. It felt all wrong. And then seeing lots of young traders, what he called not particularly smart traders, making a lot of money buying tech stocks. And he went and bought tech stocks eventually, he gave in because it was just going higher and higher. And he bought them for the wrong reason. He bought them because other people were buying them. He didn't believe in it. So he's done the fear of missing out at that point. And then the market collapsed. Okay. And, he had a disaster. He lost an absolute fortune through that performance phase. And then, he questioned afterwards whether he could do this job anymore. For him to do something like that. And he decided to take some months out of the market, and he didn't even know whether he was coming back. He withdrew from the market for the first time in his career. He told his investors, I'm going away for some time. And if you listen to the interview, I'd advise everyone to listen to that interview 2 or 3 times, okay, at least. He tells how he went away, decided to go away with his family. He told his investors he's going away. He doesn't know if he's coming back. Doesn't know if he's going to trade again. And he said he went away and he was away for about 3 months, like somewhere the other side of the world. He said he didn't look at the market. He didn't look at a newspaper. He didn't speak to anyone. He just spent time out with his family. Okay. That was him letting go. Okay. That is extreme letting go, but that's what he did on that, because he was into such a spiral and he'd become so ridden with self-doubt and disbelief and a lack of confidence. And he did come back. He came back later that year and he ended up having a fantastic year in the end. But he got back to the being phase. That was the whole reset for him, that break. And he decided after coming in to go, look, I'm good at this. I just messed up. He accepted it. He was good to himself there. He showed self-compassion, which is a key element of the letting go phase. He's human. That's what he told himself. I'm human. I mess up sometimes. I can't help it. Now he's back into the being phase and he's looking markets again when he comes back. Through this clear head, open mind, looking at everything, sees value. That's the trigger, sees the value, decides how he's going to engage with the market, puts on some trades, absolutely smoked the market, acted, brilliant performance. That's that journey through there. Is there one phase that's more important than the other where most people get stuck? No, I think I described the whole process there. It's a single process. There is not one bit that's more important. They're all equally as important. But there's one part that people don't do as well because it's an afterthought, and that's the letting go phase. And that's why that's where you win, because simply people don't do it as well. We're not, in a way, we don't think of that part of it. It's the final thought. It's the afterthought. It's the final phase. It's that we'll do it later on stuff. We know it's important, but we don't consider it as urgent.
So true.
Okay, so we think we'll do it later. We'll put it back on the back burner and we'll deal with it another time, and we don't do it.
That's definitely one quadrant. I was talking to you before this as well, that I really resonated with, the letting go phase, because I quickly realized how critical and important it is. Just on that, so I'm just going to ask a few more. I know we're running out of time a little bit, and you got to go to another meeting. Stephen, so even though you might know that this whole trading is a process-driven game for your strategy edge to play itself out, and that you need to place about 100 to thousands of trades for your edge to play itself out, impatience kicks in, especially if you're in a drawdown and you may take a trade that you're not supposed to. What causes this, and which part of the quadrant that you just explained would this relate to?
You're talking about, really, I suppose, this concept of spiraling, which happens in the it's a key element of the quadrant that takes you away from being present to your process, present to your purpose. It's the part where something happens adverse in that quadrant, and it might even start with you making an error, or just an outcome that you didn't want to happen, and it wasn't necessarily an error, but you're doing it with uncertainty. And rather than dealing with it effectively or moving on from it or accepting what happened, you can try and suboptimally correct it. It's that the way the process cycle works is that you should be kind of having a contingency for those moments, and even if you don't, just kind of closing it out. So it's a very common thing. I'll give you an example that was very common in my own trading many years ago. That I might place a bid in the market, based on some analysis I've done of the market, and let's say in the afternoon the market comes back down towards the support level where my bid was, and I would have a stop below there. And particularly if it came down really fast towards it, I'd suddenly get, I'd pre-chosen that level as a buy level, but I might start thinking, oh, maybe I'll just lower the buy level a little bit, change it a little bit, move the stop down a bit further, and try and capture a few extra points. And then the market doesn't quite get to that buy level, and it starts to bounce back up. And I'm annoyed. Why didn't I just leave the level in there rather than, and then let's move it up and hope it comes in. It doesn't come there. It carries on going up. And I get frustrated and annoyed, and eventually I just pay up for it. Which now I'm completely off process, because the only level that I really wanted to buy it was down there. I've now done an error by moving the thing, and then I've compounded it by chasing the market. Not doing a trade that was part of my process, not part of any particular risk reward strategy. And then normally I'd buy at the top and it would come down, and I'd, let's just get out of it. That's not working. Take the loss, and then it takes off, and I knew I should have bought it, chase it up there. I'm completely owned by the market now. I'm spiraling. Okay, I'm doing suboptimal behaving actions. The original mistake was actually just to remove something when I'd done some analysis that suggested doing it. And then I'm filled or I'm stopped out afterwards, and that's the trade. But I played around with it, and I've done all these sort of fixes, and I could end up in some of those trades calling the market right, originally putting on an order which would have worked well had I just bought it and then let it play out. But actually, I've interfered with it and made a complete mess of it, and actually lost money on a move I predicted. And that's an example of spiraling. And then, of course, I get annoyed, I get angry, maybe I get into regret trading scenarios or hope trading scenarios, and maybe I don't let go of that, and the next day I'm angry and I try and make the money back I should have made. And sometimes this could draw out into weeks and months, but it starts from one single process error that I did.
Oh, wow. Yeah, thanks for explaining that in detail. So the whole thing starts from this spiraling concept. Now, if I want to further that, so for example, you do talk about it in your book on the mastering the mental game of trading. And over here, I just want to share this image over here on the behavioral gap over here. Now, you see, for example, I had a question on this. So when you take drawdowns or you're in a loss cluster, naturally traders tend to reduce their position size, right? And sometimes that can be out of fear or maybe it's following their rules. Or when the rules might be saying otherwise, they still reduce their position size. And this
Mm.
may cause sometimes, of course, the system, which you got here, to outperform the actual or the cash curve,
Yeah.
which we ourselves track in our own trading performances as well. So, and that's what we call the behavioral gap. Now, we've seen this in many of our clients, right? So, where the system is outperforming the cash. Now, what is really causing this, and how can they overcome this to maintain the consistency?
It's a really good question, and I'm not altogether sure that um, that I can quite describe it because there's so many different contexts here
Okay.
that could be leading to it. Um, but it's just not a high performance mindset. It's working at a lower level of performance. So when we
Mm,
work with high performers, okay, their actual performance line is a lot closer to their potential performance line.
of course.
And one of the challenges there also is that you're never quite going to reach potential performance because the higher performance you have, the actual higher your potential performance is. Okay, so you push your potential performance. You can never actually get there.
Yeah.
You push your potential performance out. Think of it as a tennis player, and go back to someone like Roger Federer a few years ago when he was at the top of his game.
Hmm.
You know, he was constantly pushing the boundaries of his performance so he could work at a higher level. And as he did that, his potential improved. And he knew that there was no perfect. He could never get to his actual performance level.
Right.
Okay, he accepted that, but he constantly sought performance improvement. Okay, so his behavioural slippage was lower, but it was also happening to a higher potential level compared to other tennis players. Okay, and we see this phenomenon. You know, when I've this originally came from this concept from a coaching client I was working with a number of years ago, who showed me who came. You know, he was struggling in a hedge fund to make the money that he thought he should be making. And he kept a very detailed sort of track record of his ideas. And you know what actually happened was we started working on this. We started looking into this. Okay. And he was just making so many performance errors, calling the market brilliantly, but not sticking to his rules, sticking to his behavior. Um, or taking his risk down at a time. You know, you talk about taking your risk down sometimes. There's different contexts to taking risk down. Um, for example, if you're losing synchronization with the market, you're desyncing, okay, then you get defensive by taking your performance levels down,
Mm,
and then you start to resync and you reconnect.
mm,
Other times could be that the market volatility picks up a lot, and actually, you know, the same sort of 10-point or 20-point gap is not the same. You know, it means a lot in a different sort of volatility environment. So you might want to do a smaller size to sort of stay in charge of yourself as you're trading. And then sometimes, you just hit a performance, you start spiraling and you want to get out of that spiral. There's times where you get defensive until you sort of get out the spiral. And again, that sort of resynchronizing with the market. So there's different occasions for it. There's when you're in a spiral and you recognize it, sometimes you just have to step back and step away.
I see.
And that's the letting go process before you start to resync with the market.
I think the incredible thing, especially at least for me, I'm taking away, and hopefully the clients, viewers who are listening in will take away is that part where you're resetting and re-energizing is so critical, Stephen, because I think if you don't do that properly, which you talk about in your quadrant four, I think it starts to affect everything else because you're not fully ready for your peak performance and your highest performance. Am I right to say that?
Yeah. Letting go it's the part where actually that's where people who succeed engage better than anyone else. They do
Interesting.
the work in the letting go phase. That they
Wow.
do. The growth comes from that. The personal growth, the accepting the uncertainty, and the ability to, everything else. Phase 1, 2, and 3 Okay, can't happen without a strong phase 4. And the reason it's such an edge is that actually most people don't do it. It's an afterthought. You know, it is, you know, oh, I don't have time for that. Oh, I've done the trade. The trade's
Yeah.
over. I just want to forget about it. Oh, I don't want to think about it. Actually, that's what you should be doing. You should be looking back at what you did and trying to understand it and accept that, yeah, sometimes it's not going to be great. In fact, there's the other side to that where you don't let go from when you do really well. And I call it sort of remaining on the dance floor, you know, long before the music ended. And then you start giving back all the money on your next trades because you're no longer in process. You're no longer present to your process and your purpose.
So important. Thank you for all of that. Letting go and acceptance is so important that it's almost overseen. And you keep mentioning that in the book as well, but I can't agree less. It's so important. It's so critical. I can totally resonate with that. Going on to the next one, in terms of process, the place of uncertainty. Okay, so we don't know how the losses and wins come. They can come in any sequence.
Yeah.
So then, how I think maybe you might know the answer because of what you've been saying before, but I'll still ask it. I mean, so how do you come around this and whatever sequence it can come? And you mentioned 1,000 traits. Patience is required for that. What can a trader do to master patience?
Okay. It's really mastering the whole cycle. That is it. You know, if you're going to become impatient if you're spiraling. Okay. But, you know, you're more likely to be patient if you're following your process. But sometimes following your process, you know, really understanding what the job is. You know, if you came into this job and you knew, for example, that there's going to be weeks maybe where you don't get a signal. Imagine that. There's going to be weeks where you don't get a signal. There's going to be periods where you get a dozen signals in a day. You know, also, just imagining we're using a slightly longer term system rather than a short one, a short-term signal. Or you might get poor quality signals, ones that you shouldn't be taking. Okay. So imagine you're going a 2-week period without a trade. Okay. You should not be placing trades in that time because any trade you put on is outside your system, outside your process. You have to understand that. This is about knowledge of what you're doing. Okay. Actually staying with your process is what it's the process that delivers. Okay. You don't want to go off process. But that's the challenge is we've got an urge to do something. You know, we feel we're working and not doing something isn't working. And yet that's why people like Jesse Livermore said, you know, it was the sitting that made me the money. He found that so incredibly difficult to do.
That is crazy. I've seen so many traders say that. Even Amrit in the unknown market business, he says it's the sitting on the hands that makes the most money.
Yeah, I used to have, and I mention it in the book. I had a, you know, so we've sometimes had to come up with these mantras, which are kind of hacks that remind us of things. And you know, the way I traded is, you know, I could go months between a trade, or I could be really busy all the time. It all depended on market conditions, the volatility patterns of markets, whether they were in momentum periods or sideways periods. And I could have weeks or even months without a decent trade coming along. And I called it my London buses metaphor. Because when I grew up, London buses were notably unreliable. They didn't conform to their timetable. You go to the bus stop and there'd be this long detailed timetable that the bus was coming along every 20 minutes. But, you know, after an hour and a half, nothing had come along. You know, they were, and you thought, well, I'm going to walk to another bus stop. And then you walk to another bus stop on a different route. And then you see behind you, like 3 buses come along at once. And that's what trades are like. You can go through long periods with nothing. And then a whole load of trades come along at once that are great trades. And you have to know that that's how it's going to be. And you have to allow yourself to wait for that. And I would get into trouble because I couldn't wait for it. So when I gave myself, you know, this mantra or reminded myself of this mantra, it made it possible for me to actually sit with it. You know, it wasn't easy. it was really hard. And in fact, one of the traders I coached about a decade ago said, really, trading is about the art of sitting there and doing nothing much of the time. You know, that is, it's the doing something when you're not supposed to do anything that gets you into trouble.
So well said. Yeah, I believe that the viewers really get this point and really reflect on this. It's so powerful. The art of doing nothing is so important, and remaining process driven. I think one of the other questions I had was on the Susie story that you talked about on the dollar yen trade, where she then switches between the player approach and then the house approach, which we showed in the earlier question what that means. So based on that, perhaps it's the same points again. You can just be brief if it's the same points. Is that when a trader is in a trade, usually fear kicks in, or greed kicks in. Fear that your unrealized profit may diminish, or your trade may go further up for more profit. Like in Susanna's example on the dollar yen trade, where she would alternate between house and player approach, and she's kind of spiraling down, I guess, in that sense.
Yeah.
So how can a trader really overcome that?
Well, the spiraling
or just alternating between, would you call the alternating between house and player approach?
Yeah, I kind of, everyone does a little bit of both, first of all.
Okay.
But you need to have one dominant philosophy.
Right.
Where the other one might serve you. For example, I was predominantly a player trader.
Right.
My money, or in fact, all my money would become through player trades. But I did house trades because when you're house trading, you get a feel for the liquidity of the market. Okay, they generally would cost me money, and if not money, time and energy. Okay, but that gave me a sense of what the liquidity feels like, and that would help inform, my player trading. Without the sense of liquidity, and it also helped lead me towards insights and ideas, being engaged. So there was a cost to doing that, but without that, I couldn't be in the game to find the big player trade ideas. So in a way, I was doing it in a small size house trading, just to be engaged with the market, get a feel for it, get a sense for it. That wasn't how I was looking to make money, though. Okay, the player trades, the big ones, they would come from doing that. And likewise, I know house traders who every now and then they get a strong feel for a directional.
Right.
And they think, how can I best capture that? So they try and add some extra value. Okay, but they don't truly do player trades. They do it within a house trading construct. They sort of shape their book, because house trading is often when you're running a kind of portfolio. So they'll kind of take a player mindset, but the challenge is that they can't really stay with the trade for a long time.
Right.
Okay, so it's still, for them, it's house trading, but at least it gives them a sense of trying to get, see where the good risk reward is. So they might use it for that sense, but they're still, it just helps them shape their portfolio. It's actually quite a difficult concept to explain without actually going through somebody's own trading. But what I have seen over the years is people trying to do both. And when we get them to, or when I as a coach get them to realize that it's one or the other that makes the money, and put your energy there, maybe use the other one in a small way, in a supportive way, but put your energy into just one approach, then they start becoming a lot more profitable, because they start standing behind what they're doing, and that they now, it makes a lot more sense. And I don't believe one is superior to the other. I believe there's certain contexts where one might be better in that context. Okay, but generally it's you follow one or the other. It's like you cannot be in the casino both the house and the person playing against the house, and you have two different strategies for which side of the table you are. You can't play both strategies at the same time, because each side of the table has a different way of finding an edge.
I think well said. I think that's
both. If you're trying to play both, you just nullify your edge.
That's so true. I think focusing on one is always better. It reminds me of what Bruce Lee used to say. I don't fear a man who knows thousands of kicks, but I fear a man who has learned one kick thousands of times, you know.
That's
So,
right. Yes.
so I can totally resonate with that. Thank you for explaining that. We're just coming to the last part of our interview. Just speed round, very quick. What I'm just going to do, Stephen, here is that I'm just going to give you one word, and whatever that comes to your mind, you can say in one sentence. You can just say that. So the first word I'm going to be saying is risk.
What comes into my mind?
Yeah,
Reward.
reward. Nice, I like it. Performance.
Elite.
Oh, wow. And the final one, you can even say in one sentence as well. It's up to you. I'll leave it to you or one word. Success.
The ability to be present to your purpose and your process.
Oh, wow. I love that. Amazing. Ability to be present to your process and purpose. Wow, I think that's a nice, beautiful wrap up, definitely for traders to remember while they are trading the markets. Stephen, after a few loss clusters, right? So some traders lose motivation, and then it affects their consistency. So their production phase, the acting, the production, and from the being to the production, they can't click on the enter button because they've got the losses affecting them and all of that. What would your comments and guidance be to help people to maintain that consistency?
You're trying to stay on process. And
Mm.
it's not easy with the market. I often say walking to the market every day is like walking into the ring with Mike Tyson every day, and he's coming at you, and somehow you've got to survive that journey. And some days you go, I can't go back in there for another beating.
Mm.
I've got nothing left in me.
Mm.
Okay. And yet you have to, otherwise you're never going to win. You're
Mm.
never going to be able to play the game.
Mm.
So this is why having a process like this cycle is so important, and learning.
Mm.
And I work with people all the time on this. I discuss it with them. I explore it with them. I look at what they're doing. I look at what part of it, are their knots? What are these knots that we need to untie in how they're working? Is it something to do with them? Is it something to do with their environment? Is it something to do with their process, the way they're engaging with their environment? Is something faulty? Is something from the past holding them back? There's a lot within there. Is it just they're taking too much money and they're putting too much size on? They trade in the right size to their capital.
Mm.
That's going to end in tears always. But then are they not putting enough on? Are they being too afraid to act? Well, you're never going to win. And then you have to explore why. What is behind that? Okay. There's always something behind it.
Mm.
Okay. There's always something there. Is it a lack of trust in the process?
Mm.
Okay. If you can't trust your process, well, you're never going to win. Do something
Mm.
else. Uncertainty, a game of uncertainty isn't for you.
Mm.
That's what you're doing. You're engaging with extreme uncertainty.
Mm.
Radical uncertainty, it's sometimes called. So you need to have a process. You need to be able to. This lays out a process which you can look at and think about and manage. I when it comes to letting go for me, I
Mm.
tend to find, or I don't trade anymore for a living. I still do a bit of hobby trading, I call it. But when I've had a really good win
Mm.
in the past, made a lot of money, that's when I would really have trouble letting go. I would be, it was almost like I'd fallen in love with that trade. And it was like a beautiful girlfriend. And now I had to let her go, and I didn't want to do that. Actually, taking winners and getting out of the trade and not wanting to rush back in was my problem. And I would get really angry and upset and frustrated. And that would then affect the next trades I did. And I would then lose money. I'd start acting sloppily.
Mm.
Or having made a lot of money, I'd start playing loose. And
Mm.
so that was more dangerous to me than anything. So I had to learn to let go of that. And I used to decide, well, till I feel I'm ready to go back in, I'm not going to engage with this.
Mm.
So I would give myself weeks sometimes.
Nice.
losing money generally was easier because was you never go broke taking a loss. The loss was only relatively small, even if I used to have a series of them. Okay, for me they were easier to get over, but there were times where I'd be lost. It would be that what would take me into the spiral would usually be the giving back the money after having made money. That would take me into the spiral. That's what I'm talking about. I had to let go of the winning, and then I had to let go of the bad trading that would follow the winning. That was much harder. I never had, of course there were times where, if I did something and then I for example, I decided I don't like this trade anymore. I'm going to get out of it. So, and it was silly. And then it went the next day on a huge move. That of course would upset me. I'd have to deal with that and I'd have to let go of that. But I always want to make sure that I'm going back to my being phase. I mean, I'm ready to trade with the markets again, and I'm not going to be owned by it.
Nice.
So that was always the important bit. That's the connection between the letting go phase and the being phase. You can think of it. I don't know what sport you do, but if you turn up for a tennis game and you're all agitated and angry, you're not going to play well.
So true.
So that's the being phase. You've got to turn up properly for it.
Nice. I think thanks for explaining that. That's so important, isn't it? It gives you the perspective of how important these different phases in this model that you have described, and also being process driven. I mean, to be honest, even in my own trading, I think the process driven is the one that keeps me on track. When you go away from it is when the underperformance starts to happen. Final two questions. I know we're running a little bit out of time. You talk a nice example over there on detachment from curiosity using Muhammad Ali and Michael Jordan. Just to give a little bit of stats on Michael Jordan, quite interesting. To become Michael Jordan, who he was, Stephen, I'm not sure if you know this, every day he would practice 500 shots in his house for 2 times per day, right? So that's about 1,000 shots a day. In a month, you're talking about roughly 24,000. In 15 years, you're talking about 4.3 million shots. So that is incredible amount of level of consistency that these athletes are at. What would you say is the driver behind this level of consistency and playing? And the same for Muhammad Ali as well. Would you say it relates to that 3 P's of high performance that you talk about, and especially to the higher purpose?
Yeah, you need to have a purpose. You need to know your why. You need to know your intention. And that motivates you. And you've got to work towards that. So I always talk about, don't focus on outcome. Obviously, you want to set goals, but you want goals to be subordinate to your purpose and your intention. Outcomes will distract you. You get distracted because you see red, or you see, your money, your P&L is in profit. You're looking at the outcome, and you're suddenly forgetting the reason why you're doing the process you're doing. So purpose, process, and being present to them, being present to your purpose and process all the time. That's the 3 P's of high performance. And everything you do has to be connected to that. Tiger Woods, how he retrieved the ball from the hole, for him was the most important part of his game. He would have a way of doing it that would be all part of the letting go purpose and letting go of that hole and moving on to the next hole. Okay, this is what great athletes do. They create routines, habits, ways of doing something, processes, and they understand the reason for that process, the purpose.
Beautiful. And would you say?
I'm really sorry.
Yeah. The last thing is, Ray Dalio and Amrit they usually are good advocates of meditation. I mean, would you say that's a good one to incorporate it into your process, or?
Yeah, not everyone does it, but it's very helpful. It's a good thing to do. I think doing it helps you let go, but it brings your mind to the state of being. There's only good things can come from it.
Beautiful. Viewers, we've run out of time. If you got any questions, you can always get in touch with Stephen Goldstein. The book is here. I would definitely recommend it for everyone to definitely read it, Mastering the Mental Game of Trading. to know more about Stephen, where would you say they can find out more about you actually?
Well, I've got two trading businesses, Alpha R Cubed, Alpha, the letter R, then the word cubed, CUBED.com.
Would it be this one here? I think I'm just showing that on the
Yeah,
screen.
yeah. And my other one is alphamind.net. So
Uppermind.net.
you'll see the contact details on there on both of them. The Alpha Mind is more a sort of educational site. We do masterclasses and webinars and team events, whereas the Alpha R Cubed is more my own personal coaching site. So, listen, thank you ever so much. It's been great talking to you.
And if they want to get the book, it's on Amazon.
It's on Amazon and most any other online book retailers. So you can get it in audiobook, Kindle, or paperback.
Awesome. Thank you so much, Stephen, for your time. I'm sorry we overran a bit, but it was phenomenal. I think we can keep chatting for hours. It was amazing, the model that you proposed to us and everything. Once again, thank you so much for joining us on Traders Talk.
Thank you very much. Thank you.
Bye. Traders, as we always say, till the next time, stay disciplined, follow your trading plan, and keep trading like a master. Take care and bye for now.